Welcome to the deep dive. Today, we're tackling something pretty major, navigating buying your first home here in Australia. And we're especially looking at it through the lens of newcomers, drawing from some real consultation material shared with us, including a chat with a family from Ukraine.
That's right. And our mission today really is to pull out the absolute must-knows for you. We're talking about what banks are looking for, what government help might be out there, and just how to figure out where you stand financially.
Right.
We'll kind of follow that example family's journey a bit just to illustrate things along the way.
Okay, sounds good. Let's dive in and unpack this whole process. So, first things first, the sources really hammer this home. Residency status. It seems absolutely fundamental. Why is having permanent residency or, Australian citizenship such a big deal, especially if you're looking for government help?
Yeah, it's basically the entry ticket. The sources are clear. Without PR or citizenship, well, most of those government grants and benefits aimed at first-time buyers, they're just off the table for you.
So you're locked out of potentially quite a bit of support then.
For most of the main programs, yeah, absolutely. And there's another layer too. Non-residents usually get hit with an extra cost, the foreign buyer's duty.
Oh, right.
The sources mentioned it's around 8% of the purchase price. Think about that on a house price. It's a lot of extra money.
Oof. Yeah, 8% is significant.
It is. But there's a key detail here, a bit of nuance. If one person in a couple has PR, just one of you, that can actually be enough to open the door to some of the programs. That's like the absolute minimum requirement.
Okay, so that's the first big hurdle, checkpoint one. Got to have at least one person with PR or citizenship, otherwise it's just harder and more expensive.
Exactly. It's the very first thing anyone's going to look at.
Got it. Okay, so you've cleared that hurdle. Next up, money, income. I know a lot of people, especially if they're new here, worry about having casual work. Is that like a massive roadblock for the banks?
It's definitely not an automatic no, and that's really important to stress. The sources show that if your casual income is stable, consistent for more than about 6 months, banks often can and will consider it.
Really?
Yeah, they'll usually look at your income over the whole year, or sometimes they'll dig into those last 6 months of pay slips pretty closely.
Huh. I kind of assumed casual work was almost a deal breaker.
Not necessarily. Not if you can show that stability, that track record. I mean, obviously, permanent full-time work, that's always seen as less risky, even if you're still in your probation period.
Right.
I'm looking at our example family again, the husband. He'd been in casual construction work for over 2 years. The wife, full-time in a cafe for a year. The sources suggest, based on that history, the bank would probably count both their incomes.
Okay. And what if you're, say, self-employed or working on contract? Is that different again?
Yeah, it can be a bit more complex. The sources mention that for self-employed folks or those on commission or contracts, banks might want to see, say, 18 months, maybe even 2 years of solid business history.
Right, a longer track record.
Exactly. But the common thread, whether it's casual, contract, self-employed, it's all about consistency, predictability, how long you've been earning it reliably. The bank just needs to feel confident that income is going to continue.
So, banks might be more flexible than people think, but proving that income is steady, whatever the type, that's the key thing. That's actually good news.
It is. Stability really is the word.
Okay, income sorted. Now, the deposit. You need that chunk of money up front, and this term, genuine savings, keeps popping up. What are banks actually getting at with that? It sounds a bit like jargon.
It does, doesn't it? Essentially, it's the bank wanting to see proof of your financial discipline. Can you actually save money consistently over time? That's what they want to know.
Right.
The clearest way, according to the sources, is just having that deposit money sitting in your bank account for, say, 3 months or more. Or, alternatively, if you can show you've been regularly putting money aside into savings, that pattern of deposits, that works too. Shows you're actively building it up.
Okay, but what if, you got a gift? Maybe family helped out with a lump sum recently, so it hasn't been sitting there for ages.
Yeah, that makes things a little bit trickier. A gift isn't a deal breaker, but the bank will definitely want more information. They'll need documentation and explanation of where it came from. It doesn't quite show your saving habits in the same way. But here's something interesting the sources brought up. Some banks, not all, mind you, but some, will actually look positively on a solid rental payment history. Like if you've paid your rent perfectly on time for over a year.
Wait, really? Being a good renter helps you buy? That seems unexpected.
Well, it doesn't replace the need for the actual deposit cash, let's be clear.
Right, okay.
But it sends a good signal to the bank. It shows you can handle making large, regular payments, which, is pretty much what a mortgage involves. So while it's not genuine savings in the strict sense, it can be a real plus in your overall picture for the bank.
That's actually a brilliant tip. Okay, let's switch slightly. Credit history. If you're new to Australia, maybe you don't really have one. How do you start building that up? And how do you even know where you stand?
Yeah, super important piece, this one. A clean credit history is vital. And it might sound weird, but the sources actually suggest that sometimes having no history is better than having a bad history. One with missed payments and defaults.
So a blank slate is better than a messy one.
Pretty much. A bad record is a big red flag, but building a good one, totally doable. The sources suggest simple things. Switch your prepaid mobile to a contract plan. Just having that monthly bill and paying it on time helps.
Oh, okay.
Paying your utilities regularly, power, internet, all that stuff gets tracked and builds a positive footprint. And definitely check your own credit score. Use one of the bureaus like Equifax. A score over 600 is generally seen as pretty good. The main thing, the absolute golden rule. Always, always pay on time.
Okay, so key takeaways so far. Residency sorted, stable income shown, even casual. Prove you can manage money via savings or maybe even rent, and build that clean credit profile. Right. Now, let's talk about the help available. Specifically in WA, Western Australia, where our example family lives, what government support schemes did the sources highlight there?
Okay, yeah, WA has a few key ones. There's the first homeowner's grant, that's $10,000, but it's mostly if you're buying or building a new place.
Right, for new builds.
Then there are stamp duty concessions. This is a big one. You could pay zero stamp duty on homes up to $500,000, and you get a discount above that, up to a certain limit. There's also the First Home Super Saver Scheme using your superannuation savings. But probably the one that makes the biggest immediate difference to upfront costs for many is the First Home Loan Deposit Scheme, the FHLDS.
Right, the FHLDS. I hear that mentioned a lot. Tell me more about that one. What's the main benefit? Why is it such a big deal?
Okay, the absolute killer feature, the real game changer is this. The FHLDS lets you buy with only a 5% deposit. And this is the crucial part. You don't have to pay lender's mortgage insurance. LMI.
LMI. How much does that usually cost? Is it a lot?
It can be really substantial. The sources estimate LMI is often around 4% of the property's price. It's on a sliding scale, so the less deposit you have under 20%, the higher the LMI rate. But yeah, 4% on, say, a $500,000 home, that's $20,000.
Wow.
That's $20,000 extra you need up front. The FHLDS just wipes that cost out completely. Plus, avoiding LMI can sometimes mean you have access to more banks, maybe even slightly better interest rate deals.
Okay, dodging that LMI payment sounds incredibly attractive, massive saving. But there must be eligibility rules, right? What are the catches?
Oh, definitely. There are rules. You need to be an Aussie citizen or have PR. There are income caps. Currently, it's $125,000 a year for a single applicant, $200,000 for a couple. And importantly, there are limits on the price of the property you can buy. These caps vary depending on where you are in WA. For our example family, the limit in their area was $600,000. But they were hoping for something around $650,000.
Ah, so they were just over the limit.
Exactly. So unfortunately, that specific property price meant they couldn't use the FHLDS. The sources did mention there's sometimes talk about adjusting these limits, so, they could change.
Right. So FHLDS exceeds amazing for upfront costs, but only if you fit neatly inside those income and price boxes. Okay.
Right.
Which leads to the next big question. How much can you actually borrow? What's this borrowing capacity thing all about?
Yeah, look, you might hear this really rough rule of thumb floating about, like take your annual pre-tax income and multiply it by 4.
Okay. Sounds too simple.
It is. The sources are super clear on this. Do not rely on that. It's like, guessing the weather by looking at one cloud. Banks go way deeper.
Right.
They look at your income, yes, but then they factor in all your expenses. How many kids you have, any other loans, and this is a big one, credit card limits. Even unused ones, insurance, school fees, everything.
Okay.
So for our example family, earning about $140K combined, if, and it's a big if, they had zero other debts, maybe their capacity is around $500,000 to $560,000 maybe. But, and here's the giant but.
Let me guess. That but involves things like a car loan. You mentioned that could be a trap.
You nailed it. Existing debt and car loans are a prime example, according to the sources, can absolutely slash your home borrowing power. The impact is huge.
How huge are we talking?
Like even a car payment that seems okay, say $800 a month, that alone could potentially reduce the amount a bank will lend you for a house by maybe
$100,000.
Get out. $100,000 less borrowing power because of an $800 car payment? That's staggering. That's a critical piece of information. It really is. It can drastically change what kind of property you can even look at. Which is why the advice you often see in the sources is, if you possibly can, sort out your mortgage first, then think about the car loan or other big personal loans after.
Oh, that is incredibly practical advice. Could save someone a world of pain later. Okay, so borrowing capacity depends heavily on expenses, not just income.
Got it. So let's try and crunch some numbers based on the source estimates. What kind of total upfront cash are we talking for homes at, say, $500K, $600K, and $650K, factoring in deposit costs, LMI if it applies?
Okay, let's walk through those based on the source estimates. First, a $500,000 place. Assume you do qualify for FHLDS and you get the full stamp duty break. Your 5% deposit is $25,000. Then add other costs, lawyers, government fees. The sources estimate around $11,500 for those.
Okay.
So total upfront needed roughly $36,500.
Right. Doable if you get the FHLDS. Now, $600,000. This is right on that FHLDS limit in the example region. 5% deposit is $30,000. Stamp duty won't be zero here. It'll be partial, and other costs are a bit more, maybe $26,500 according to the estimates. Still no LMI because you're in the scheme. So total upfront, about $56,500.
Okay, stepping up, but still avoiding that big LMI hit.
Exactly. But now jump to $650,000. This puts you outside the FHLDS price cap for that area. Even if the bank lets you do a 5% deposit, $32,500, other expenses are estimated higher again, maybe $29,000. But the killer is the LMI, because you're not covered. That could add, based on the estimates, another $25,000 to $27,000 just for the insurance.
Wow.
So your total upfront cash needed suddenly jumps to somewhere between, say, $86,500 and $88,500.
Goodness. Looking at that $600 case scenario needing about $56 in a 5K versus the $650K needing over $86K, that LMI is just...
That's a massive difference in cash needed right at the start. Huge difference. Which is why the sources constantly stress. If you can possibly save more deposit, aim for at least 8%, ideally 20%. Getting to 20% knocks out LMI completely and usually gets you better loan terms, better rates, too.
Rates.
The sources also give a quick mention to Key Start. That's a specific WA government lender. Might have slightly different rules, maybe softer conditions for some people. So that's flagged as another potential path worth checking out if standard bank loans seem tough.
It really paints a picture, doesn't it? Buying your first home isn't a sprint. It's definitely more like that marathon you mentioned. Needs planning, building that trust with lenders, understanding your numbers, and knowing about these programs.
Totally. And the sources offer a neat little self-assessment tip for listeners.
Oh, yeah.
Add up what you currently spend each month on rent, plus whatever you're managing to consistently save.
Yeah.
Get that total figure. Then, compare it to what you estimate your future monthly homeowner costs will be: mortgage payments, utilities, council rates, insurance, the lot. If those two numbers are kind of in the same ballpark, the sources suggest that's a pretty good sign you're likely financially ready for the ongoing commitment.
That's really practical, something anyone listening can do right now to gauge things.
Well, this has been incredibly useful. We've really laid out the map, haven't we? Covering those crucial checks and balances based on the source materials.
Yeah, hopefully demystified it a bit. And maybe just one final thought to leave you chewing on. You know, there's always talk about government programs changing, interest rates potentially moving up or down. How does that play into your timing? Is it better to maybe wait, hope for slightly better conditions down the track, but risk prices going up more? Or do you weigh up the current risks and opportunities and decide to act now? Something for you to really consider based on your own situation.
A classic dilemma. Risk versus reward, timing the market. Lots to think about. Thank you so much for breaking all that down for us. Hopefully this deep dive helps you listening feel a bit more empowered on your own path to potentially buying that first home. Keep exploring those options.